As one of the fundamental rules of investing, diversification is the idea of allocating an investor's money across multiple investment categories spread over different industries and sectors. A comparison of this strategy can be made to the age-old adage of not putting all your eggs in one basket. Where the former is equivalent to an undiversified portfolio, putting your eggs in several baskets is equivalent to a diversified portfolio. The core rationale behind diversification is to minimize an investor's risk exposure. By doing so, this strategy allows the investor to spread out the downside risk. For example, an investor puts all their money into ABC stock. After a short period of strong performance, ABC company surprisingly runs into financial troubles, and the stock price drops dramatically, losing a majority of its value. It would be unfortunate for that investor, since he would have lost the majority of the value of his portfolio. If instead the investor put his money into ABC as well as several other stocks in different industries, he could have likely minimized his loss from that one isolated event in ABC and have the other stocks compensate for that decline. Portfolio diversification is not limited to just within a particular asset class, but instead should additionally be applied across several asset classes. A popular portfolio allocation has been 60% in stocks and 40% in bonds. By averaging out the risk and return of a portfolio over different stocks and bonds, an investor is able to greatly reduce the risk exposure while still being able to maintain modest returns. Take, for example, an investor interested in investing in Sears. Without knowing the downfall of Sears as we now know, it would have been reckless to invest solely into Sears without diversifying. Using the CRM2 Plus software, we can illustrate the fair market value of a portfolio with just Sears versus a diversified portfolio which includes Sears as well as various other stocks. By investing in a range of stocks across different sectors, an investor can minimize the losses by having the other stocks compensate for the decline of Sears. You can see at the end of 2017 the value of the portfolio. A well-diversified portfolio clearly gave a higher return and reduced the risk of a single stock's downfall. Overall, diversification will yield higher returns for an investment portfolio by lowering the unsystematic risk of severe loss in an individual investment. It is a risk management practice that should be implemented by all investors who want to achieve long-term success in the performance of their portfolios.